Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, there are two things weighing on markets this week, especially in Europe, and that is what is happening with monetary policy in the US, but crucially, the rise in COVID cases in Europe. Now, the week had got off on a back foot when US President Joe Biden nominated the current US Federal Reserve Chair, which is Jerome Powell, for a second term. Now, bond markets especially didn't like this, as they see Powell as probably the most hawkish candidate and likely to pursue a more aggressive route on monetary policy, which means likely to raise interest rates faster and taper QE more quickly. Now, if you look at the chart of the 10-year US Treasury yield on your phone, for example, you will see that it popped back to its October high of 1.67% in the last 24 hours. And it will be interesting to see whether the 10-year US Treasury yield can finally break above this recent high. Otherwise, we could be setting up an interesting technical analysis pattern called a double top or a triple top, which could be negative for yields. It can be a bearish pattern, but that will be negated if the yield keeps pushing higher. Now, a deciding factor could be the latest US inflation figure, which is due out today. And we seem to be in this constant, almost never-ending cycle of news about inflation, latest figures, and the market's reaction to it. Now, in the UK, bond yields also climbed higher this week, with the 10-year UK gilt yield back above 1%, but it's a slightly more mixed picture in Europe. Now, last week we started to see signs of divergence, with bond yields falling in France and Germany against a backdrop of rising yields in the US, but the contrast is less stark this week. Now, playing into this and the more muted yield picture in Europe is the backdrop of rising COVID cases on the continent and restrictions and lockdowns being reintroduced. Now, both of these are obviously bad for economic growth prospects, which in turn is positive for bonds. So that's why we've seen bond prices be supported, which means that bond yields in Europe have been suppressed. Now, interestingly, the concerns over COVID at the start of the week had seen investors start to behave in ways that they did back in February, March 2020, which means they started to look towards haven assets such as bonds. And so they drove up the prices, driving down the yields, as well as starting to go back into technology stocks. And we're starting to see technology stocks push higher. But the Powell nomination is a competing narrative to the COVID one. And another 4 years at the helm of the most influential central bank in the world sent equity markets into a bit of a tailspin. And that was after bond markets had already started wobbling. Now, the impact was to drive investors away from perceived haven assets once again. And that means away from bonds and gold, interestingly, but also away from technology stocks. And we saw all of these assets, which they do tend to underperform in a rising rate environment, start to tumble. Now, since the start of the week, gold has been, it had been enjoying a period of relative strength, tumbled more than 2.5% in the last couple of days. Now, the market seems to be more scared of Jerome Powell and the Federal Reserve and their aggressive monetary policy, or the potential for aggressive monetary policy, than they are about another wave of COVID. Now, if we look at the VIX, which is the market fear gauge, which measures basically future volatility expectations on the S&P 500, now that broke higher and is back above 20 today. And the equivalent on the Nasdaq 100 is back above 25. Now, these aren't extreme levels by any stretch just yet. And in fact, they're broadly just in line with their long-term averages. Now, indeed, the CNN Fear and Greed Index, which is an indicator made up of 7 factors that combine to give a indicator. If you look at it, it's actually a gauge that runs from fear on one side to greed on the other. And it aims to give a simple indicator of the emotion that is driving markets. So you wouldn't bet the house on it, but it's interesting nonetheless. And actually, we are now moving back away from extreme greed, which we had last week, back towards a more balanced makeup of fear and greed. So it just shows that panic isn't quite driving the market yet, despite the headlines you may be reading, but it's becoming a bit more balanced. We are starting to get a bit of profit taken, and perhaps that shouldn't be surprising given how markets have behaved of late. Now, the FTSE 100 is still hovering around 7,300, while the tech-heavy Nasdaq is down almost 3% this week. The Dow and the S&P 500, they're only down around 0.5%. Now, if you jump to Europe in the equity market space, the picture's a little bit more red, with the German DAX down 2.3%, while the broader Euro Stoxx 50 is down nearly 3%. And there's a trend for value stocks to outperform growth stocks after that Powell nomination. But none of those numbers are disastrous. And the uptrends in most developed world markets remain intact. And they've had a good run since the September low. So, as I suggested, it perhaps shouldn't be a surprise that we've seen a bit of a pullback. It's almost inevitable, even during this seasonally positive time of year. But the return of Powell has reignited the strength of the dollar. Now, this is something to keep an eye on, as it could create a headwind for US equities. It certainly already has created a headwind for emerging market equities, where we've seen a lot of emerging market funds falling 5% in recent days. Don't forget that a strong dollar is generally weak for emerging market companies that have assets in their local currency but tend to borrow in dollars. Now, it's a trend to keep an eye on in the coming days, this strength in the dollar, and also keep an eye on those rising COVID-19 case numbers in Europe. But right now, markets seem to be most frightened about Powell and what the Fed might do that could bring everything crashing down. So that is it this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, Twitter, the usual money to the masses with a number 2. We're on TikTok, we're on Facebook, we're on Instagram, and most of all, don't forget to subscribe to our YouTube channel.